The world of trading and investing is packed with bold headlines, flashy screenshots of overnight gains, and stories of people turning a small account into something extraordinary in just a few days. Social media is flooded with influencers posing in front of luxury cars, tropical vacations, and expensive watches, all claiming that high-risk trades are the fastest path to freedom and wealth. It's easy to be drawn in, especially when you're ambitious, hungry for change, and tired of waiting for success to show up slowly. But behind the curtain of hype and instant gratification lies a truth that rarely gets promoted. High-risk trades almost never build lasting wealth. They might produce a thrilling win here or there, and occasionally someone gets lucky and posts dramatic gains, but the reality is that consistently taking oversized risks is more likely to drain accounts over time rather than grow them. Today, we're diving into why that happens and what the real foundations of enduring wealth look like. To understand why high-risk trading is so dangerous, you have to first understand human psychology. When a trader takes a risky position and wins, even once, the brain releases dopamine, a powerful chemical that reinforces behavior and fuels excitement. Suddenly, the trader believes they have discovered a shortcut, and the memory of that big win becomes addictive. They feel invincible, convinced that if it worked once, it can work again. The problem is that the same dopamine rush blinds them to the long-term reality of probability and mathematics. The market does not reward recklessness forever. Eventually, probability catches up, and the same trade that once produced euphoria ends in devastation. Instead of learning discipline, many chase losses, trying to recover quickly, which pushes them into an even more dangerous psychological loop. Risk becomes more seductive when people mistake luck for skill. Someone can open a trading account, take a massive leveraged position, and triple their money in one move. But luck disguises itself as talent in the moment. High-risk trading can give the illusion that you're in control, that you're smarter than the market, or that you found a secret strategy. Then, when the inevitable loss lands, it feels unfair or shocking rather than expected. That's why many traders blow up accounts not once but multiple times. They don't adjust their behavior. They simply deposit new money and repeat the same dangerous approach, expecting a different outcome. In contrast, truly wealthy traders understand that consistency beats intensity. They don't rely on luck, once-in-a-lifetime moves, or emotional impulses. They rely on probability and discipline. Another reason high-risk trades fail to build lasting wealth is the mathematical reality of drawdowns. If you lose 50% of your account, you don't need a 50% gain to break even. You need a 100% gain. Losses weigh more heavily than wins. A few reckless decisions can destroy months of disciplined gains. High-risk traders frequently underestimate this dynamic. They assume a big win is waiting around the corner to reverse any mistake. But probability doesn't care about optimism. If you risk too much per trade, it's only a matter of time before a string of losing trades wipes you out. Even the best trading strategy experiences periods of drawdown. Professional traders prepare for that by limiting position size so no single trade has the ability to ruin them. High-risk traders treat the market like a lottery ticket, and the math eventually punishes them. Many people believe that high-risk trading is necessary because small accounts seem impossible to grow otherwise. The logic is understandable. If you have $500 or $1,000, it feels useless to make $2 or $3 per trade. You see others pulling in hundreds or thousands per day, and the comparison ignites impatience. This mindset creates pressure to rush progress rather than build foundations. But the reality is that impatience is financial poison. Every successful trader started small. They respected the process. They learned risk management long before they tried to scale profits. The same is true in any business. You don't build a skyscraper starting with the top floor. You lay a stable foundation. High-risk traders skip the foundation entirely because they don't want to feel small or slow, and the price they pay for that impatience is often their entire account. Another major misconception is that high-risk trading is necessary to achieve financial freedom fast. What often goes unspoken is that the path to financial freedom is rarely fast. Even in the world of professional trading, hedge funds, prop firms, and institutional investors, where the smartest and most well-equipped traders work, returns are built through careful strategy, discipline, and moderate risk. If high-risk gambling really worked, Wall Street would be doing it every day. They're not. They are obsessed with managing and controlling risk because that is how real money behaves. The wealthiest investors measure success not by how much they can make in a single trade, but by how long they can stay in the game. Staying in the game requires survival. Survival requires risk control. The wealthy don't chase home runs. They build portfolios that compound over time. Compounding is one of the most powerful forces on the planet, yet it only works when you protect your capital. Compounding multiplies consistent small gains into massive results, but it needs time to work its magic. High-risk trading interrupts compounding because blowing up an account resets progress to zero. Compounding thrives on patience, discipline, and steady growth, not reckless bets. Think about saving money. If someone consistently invests small amounts with a realistic rate of return, they build real wealth over years. But if they constantly gamble their savings on lottery tickets or casino tables, occasionally they might win big, but most of the time they end up worse than when they started. Trading is no different. The compounding machine only turns for those who protect their principal. There's also a confidence problem at the root of high-risk behavior. Many traders take oversized positions because deep down, they don't trust their long-term ability to succeed. They don't want to wait, they don't want to grind, and they fear that if they use proper risk management, they'll never reach the level they imagine. So they try to shortcut the process. But shortcuts are illusions. They look like progress but lead to setbacks. The most skilled traders build confidence by mastering process, not by chasing outcomes. They journal their trades, refine their strategies, and focus on improvement rather than jackpot wins. When you trust the process, you no longer need to gamble to feel hopeful. A crucial thing that rarely gets discussed is survivorship bias. For every trader who posts a screenshot showing they turned $200 into $20,000, there are thousands who lost everything and quietly disappear. You only see the survivors, never the casualties. This creates the illusion that success is common when, statistically, most traders fail because they blow up their accounts before they ever develop real skill. Influencers know that high-risk returns attract views. Platforms reward sensationalism over truth. But screen culture is not reality. Lasting wealth is built behind the scenes, away from social media, in hours of practice, discipline, and patience that nobody celebrates. Another reason high-risk trading fails is emotional instability. When the stakes are too high, decisions stop being rational. Fear and greed take the driver's seat. A trader who risks 1% of their account per trade can remain calm and follow their plan. A trader who risks 20%, 50%, or even 100% is in panic mode every second the trade is open. They're watching every tick of price movement with tension. And when emotion takes over, logic disappears. Emotional trading is impulsive trading. Impulsive trading is destructive. Wealth is not built when decisions are made from a place of anxiety or desperation. Wealth is built when decisions are structured, thoughtful, and controlled. It's also important to look at the life cycle of high-risk traders. Many start optimistic and energized, fueled by dreams of fast success. They win a few trades, become confident, then increase size. Eventually they take a major loss, grow emotional, chase losses, and then drain the account completely. After that collapse, they feel shame or frustration and either quit trading entirely or repeat the cycle. Very few transition into disciplined traders, but those who do only succeed because they eventually abandon high-risk behavior. If high-risk strategies actually worked, traders wouldn't need to reinvent themselves. The cycle exists precisely because high-risk traders are consistently destroyed by their own approach. For traders who want real, lasting wealth, the solution is surprisingly simple. Focus on risk management and consistency. Wealth in the markets comes from protecting capital first and growing it second. A profitable trader can survive losing streaks because they never risk enough to knock themselves out. They understand that trading is a long game measured in years, not days. They stick to rules. They never take trades they can't emotionally afford to lose, and they allow compounding to work its magic. Instead of asking, "How much can I make today?" they ask, "How much can I protect today?" That is how real wealth builders think. Lasting wealth also comes from diversification, not putting everything into a single trade or a single type of asset. Wealthy individuals spread risk across investments, stocks, real estate, business ventures, long-term holdings, and only a portion in active trading. High-risk traders typically put everything into one place and hope it behaves. Hope is not a strategy. Wealth is built through structure, balance, and intelligent allocation. The more diversified you are, the harder it is for any single mistake to ruin your future. Wealth is protection first, growth second. Another powerful concept that destroys high-risk thinking is the idea of process mastery. Every master trader focuses obsessively on learning, understanding market behavior, refining edge, testing strategies, analyzing performance metrics. High-risk traders skip learning in favor of action because they want excitement and speed. But skill takes time. Skill must be earned. And in trading, skill is what separates the wealthy from the broken. Once you develop real skill, you no longer need wild risk. You grow consistently because you understand your edge and apply it repeatedly. High-risk traders trade emotionally. Skilled traders trade mathematically. There's a hidden truth about wealth that is rarely talked about. Real wealth is boring. It's stable, consistent, and gradual. High-risk trading, on the other hand, is thrilling, dramatic, and chaotic. But excitement is expensive. The people flashing rented Lamborghinis online are selling adrenaline, not financial education. Real millionaires are not sitting at a computer screaming over charts. They are calmly executing disciplined processes. They know that slow is smooth, and smooth becomes fast. High-risk traders are chasing fireworks instead of building engines. If you genuinely want to build wealth through trading, remember that your goal is to stay in the game long enough for compounding and skill development to transform your future. You don't need giant wins. You need controlled losses. You don't need to impress strangers with screenshots. You need a repeatable system. Small wins compounded over time outperform reckless bets disguised as opportunities. Consistency is not glamorous, but it is powerful. And at the end of the day, wealth is measured not by how quickly you make money, but by how long you keep it. So the next time someone tries to convince you that high-risk trades are the fastest path to riches, remember this: wealth that comes quickly usually disappears even faster. Luck cannot be replicated. Discipline can. High-risk trading creates temporary thrills. Low-risk consistency creates lifelong freedom. The traders who win are not the ones who swing the hardest. They are the ones who control themselves the best. It's not about making money fast. It's about building something that lasts. And when you think about your future, ask yourself, do you want to gamble your goals, your stability, and your peace of mind for a chance at excitement? Or do you want to build real wealth, brick by brick, knowing that every step forward is secure? The choice is yours. Just remember, empires are not built overnight. They are built through patience, structure, and the courage to do things the right way, even when the wrong way looks easier. Because lasting wealth is never an accident. It is built deliberately, responsibly, and consistently. High-risk trading destroys more dreams than it fulfills. Choose the path that gives you a future, not just a moment. That is how real wealth is created, and how real freedom is earned.